Welcome back to Corporate Radar. Let's talk about Castrol's numbers. It was a good set of numbers, actually. Both revenues and EBITDA witnessed healthy growth. The company also managed to maintain its operating profit margin level. Sandeep Sangwan, the managing director at Castrol India, joins us now to talk about that. Sandeep, thanks for joining us. Generally, when we get the earnings, we don't really get a handle on what the volumes have looked like. So can you help us with that? What was the volume growth this time? What was the realization growth? And what is a sustainable volume growth number you can do by the end of the year?
So, first of all, good morning to everyone, and thanks for having me on your channel. I think we posted, as you said, we have a good set of numbers. Our revenues up about 7% year on year. Our PBT is up about 9%, and I think it's a mix of volume and top line growth, revenue growth. So our volume growth would be in the range of about 4%. 3 to 4%, and I think we see that volume growth going forward. And the set of numbers has also been helped by some of the new product launches that we did. We launched magnetic SUV in the car segments because 50% of the new vehicles sold are cars. We entered a slightly lower price point category in the commercial vehicles with CRB Essential. We launched Castrol On. So overall, we're very happy with the results, and we've also declared an interim dividend of 3 rupees per share. So quite happy with the numbers, and we see the second half also. While I wouldn't like to give any guidance, but we see a quite good second half coming through with the cost inflation having eased in the last 6 months.
Mr. Sangwan, hi, good morning. So you gave us a sense of the volume growth, which you're confident on. What about value growth? Are prices rising, or are you holding the price line to encourage more volumes? And what's the outlook on that balance for the rest of the year?
Yeah, so typically we have a strategic pricing framework which we operate with. As you know, we are a premium branded player in the market, and we would like to hold our premiums. But at the same time, we also believe in giving the right value to our consumers and customers. So I think as we get into the second half, we'll keep that in mind in terms of delivering value to our consumers and customers. And typically in the first half, we've actually, some of the cost savings have been passed on to consumers and customers, but we would like to hold our margin at, normally we say we'll hold our margins at 23-24% level, and that's what we try and maintain.
So you've done some price cuts, is the sense that I get. You've passed on the cost benefits. Going forward, as you look to hold that margin line, are you expecting stability or more easing? What's the outlook?
We expect to see stability in the market now with some of the cost pressures having eased off, okay? But we never know how the next 6 months are going to turn out. We operate as per our strategic pricing framework and a band of premiums that we want to hold versus the average market prices. So we keep evaluating the situation and keep taking corrective actions as may be needed.
Okay, got it. All right. Good morning, sir. Thanks so much for speaking to us. Well, industrials is around 10 to around 12% of your business, I believe. How are you seeing that segment shape up, and do you want to increase the exposure out there?
So definitely, I think industrial is a key focus area. We operate in key segments of the market where we can differentiate our products and offer differentiated value to our customers for total cost of operation perspective. So it is going to be an important part of our business, and we see growth in that business. In the first half, we've grown in that business, and this quarter also, both top line and margins have expanded in that business. And I think as manufacturing activity picks up, and with the economy and in emphasis on capital expenditure, we'll continue focusing on that segment as a growth segment.
But, just coming back to this margin argument, right? You said that you're holding on to your margin guidance of 23%, but earlier, I mean, the quarter was supported because of lower crude prices, but now crude prices have surged yet again. So how are you so confident that you could hold on to this figure?
So I think we continue investing in our brand. We continue our advertising expenditure behind investing behind our brand. So that helps us hold our margins. And in an inflationary environment, as we saw last year, we're also able to kind of take pricing actions to protect our margins. And as I said in the beginning, we'll continue holding on that. And I think we also have some good new product introductions. We're expanding our network, so that also helps us. So, for example, we have 350 Castrol Auto Services today across almost about 100 cities in India. We have 5,500 bike points. So we're working on various parts of our business to make sure that we are able to protect our margins, and we've done that historically. So I don't see any issue as far as that is concerned.
Okay. And this acquisition of Key Mobility, can you tell us whether you've completed that and what is the way forward? I mean, how does it add to your, your revenue stream?
Yeah, so I think that investment is progressing very well. We completed the transaction in January. I think Key Mobility business is performing well. And we've also started kind of working together around synergy areas. For example, Key Mobility has a spare parts offer, which we've been able to offer to our network. We are supplying Castrol branded lubricants to the Key Mobility network, which is expanding day by day. So overall, we are very happy with the progress that that investment is making.
Okay. All right, Mr. Sangwan, we'll leave it on that note. Thank you very much for joining in. Appreciate you being with us. That's Castrol trends at the end of Q1. The market